sat next to him. We're trying to imagine ways this could be really fascinating.
Well, they do that at the ECB. It would make it more interesting if more of them came out. And you could hear from the others as well.
Or even look at their facial expressions.
I'm just saying that for Governor Waller, there's been a real change, I think, from Governor Waller. And when you speak to people, when you speak to them privately, they're much more willing to say that it sounded like an audition. Neil Dutta of Renmark basically said it in a note in the last few weeks.
There is a sense that his coming out and saying really vocally that some of the tariffs would not affect the downward trajectory of rates and that he still sees a disinflationary process well underway clearly was playing into the hands of a policy that this president has at play. That said, there are a lot of people who would agree, and it all depends on exactly how those tariffs are implemented.
We just talked about the Federal Reserve for 4 minutes, and if you're just tuning in, that's 4 times as much as we have throughout the whole programme so far. Coming up, Binky Chadha of Deutsche Bank as stocks move higher ahead of the Fed. Pierre Ferragu of New Street previewing earnings from Tesla, and Lorena Urucci of T. Rowe Price counting down to the first Fed decision of 2025. We begin this hour with stocks little changed. Investors looking ahead to this afternoon, a Fed decision and earnings from Meta, Microsoft and Tesla. Binky Chadha of Deutsche Bank also keeping an eye on Trump's tariff policy, writing equity markets at record highs will be tested by more trade escalations. Equity positioning is elevated and will continue to whipsaw on trade headlines. Binky joins us now for more. Binky, good morning.
Yeah, good morning.
It's good to see you. Thanks for sitting through that. We appreciate it. Let's talk about trade. It's a key deadline this weekend. Are you expecting a change?
I think it's pretty close to 50-50. I'd put the odds of getting something big below 50. Yes, the note you read out from Friday, we did have a peak in the market last week. And the script from the last trade war was markets do well. Emboldens basically the stance on escalating on trade. Market sells off, which we also had on Monday, sort of changes the dynamic a little bit, and there's a reason for a pause.
So let's split up the two stories if we can. Can we just sit on trade just for a while longer?
Sure.
Do you think it caps multiples of the companies that are exposed to that story? And is GM a decent example? Lisa brought this up earlier. GM came out with fine numbers, but I think people found it difficult to put much weight on the outlook, given how trade dependent that might be. How does that complicate valuations going forward for those sectors?
So far, I would say in general, and going back to the note on Friday, so things moving around pretty fast.
Sure.
But if you take a look basically at, the market down, the market recovery, I mean, basically what you're seeing is actually, the most tariff exposed sectors actually outperform the market slightly. So they're moving with the market. So I would argue, right now, the equity market has not really priced in anything for tariffs. And that, we can debate whether that's reasonable or unreasonable. I would argue, tariffs are going to come. They're in our house economics baseline. Of course, the precise numbers, magnitude, trajectory, timing, can be different. But we have still basically, one of the highest macro forecasts from Matt Lazzetti on the street for what growth's going to do this year. So I would argue what matters for equities at the end of the day is what that does to growth. And right now, I think it's just a little bit unclear. There's not just the tariffs, but there's plenty of other things happening. I would also point out, in terms of thinking about the tariffs, there's a number of things that are pretty different this time relative to the last time. Last time around, I would argue, the tariffs were really a big surprise. This time around, it's arguably the most anticipated, most talked about policy change that's coming. And so the dynamics are going to be very different when something is a surprise and when something is anticipated.
Okay, so you've said two things here. I'm jumping in because you said that on one hand, it's not being priced in. On the other hand, it's not a surprise. So can you reconcile those two things in terms of which sectors, which have been relatively immune to concerns about tariffs, could potentially see the biggest drawdowns if we do see on February 1st, on Saturday, these tariffs implemented?
So I would add two more things before I answer your question. And what I would say is, if you talk to companies and listen to companies, and one of the reasons why things are not priced in on the tariff front is they tell you that basically, since the last trade war, we've had basically a lot of experience, courtesy the pandemic and geopolitical issues, on managing our supply chain. So I would, as we say, basically, companies say they're essentially battle ready, bring them on. I would also point out that, this is about a change in U.S. trade policy and higher tariffs. But, as one company put it, look, we have tariffs in every country and they change around all the time. We have to deal with it. So, I think there's a shock impact that the fact that the U.S. is going to do it. And I think that basically, it's diffused somewhat by being highly anticipated, not perhaps the precise, magnitudes and the direction. But I would say otherwise, I think the market's in a pretty reasonable place on the tariffs. Yeah.
What's fascinating to me is that the market might be in a reasonable place, but you also point to how high valuations are and that people are feeling jittery, and that tariffs being announced, or say what happened over the weekend with DeepSeek and how much that rattled the tech industry, is indicative of where we are in a market cycle and the nervousness about valuations. How are you adjusting your outlook based on that, just that kind of dynamic alone?
So actually, our view for the year is that there are good reasons for why multiples have gone up, and our bottom line is multiples are likely to stay here, if not squeeze higher, is the way I would put it. Sort of a longer discussion, but I would say at least sort of 4 reasons for why multiples have gone up. One is sort of an older reason. I mean, everybody talks about 15 times as the historical average for the S&P 500. I mean, if you take a look at just the trailing multiple for the S&P 500, we really haven't spent much time below, 15 times since the late 1980s. So multiples moved up earlier, and that I would ascribe to basically inflation moving to a 2% world from what it used to be. Number 2, I would say, take a look at total payout ratios in the U.S. They used to be between 50 and 60%. At the tail end of the post-global financial crisis cycle, we ran up to 80, 85%, and we stayed there for a while. It's huge change in payout ratios. So, that's a 45% increase from 55 to 80. That's a 45% increase in the earnings that go to shareholders. And then, if you just did a quick present value calculation, it would tell you that if payout ratios go up by 45%, fair value multiples should go up by 45%.
How much of this is linchpin?
2 more reasons why multiples are.
Well, but hold on 1 second. Can you do it quickly?
Absolutely. So, what is trend earnings growth for the S&P 500 over the last 100 years or 90 years? It's 6.5%. But if you take, a rolling 10-year read on what earnings are doing, we're running at 9%. And when was the last time we had as high a number for rolling 10-year earnings growth? It's the second half of the 90s. And then I would say, take a look at, the risk in equities at a fundamental level comes from earnings and big drawdowns in earnings. And, those have generally been associated basically with recessions. So if you just take, the crudest metric, how long has it been since a 10% drawdown in earnings? And what you will see is that that's arguing, multiples are following that. Multiples followed that in the second half of the 90s. And so, that's why I say multiples could squeeze higher. They're pointing a lot higher. Yeah.
Binky, appreciate your time and the explanation.
Pleasure.
Got through all 3 in the end, without Bramo's interruption.
I'm sorry, I feel rude. I was getting so excited. There are a lot of ideas baked in there, and so I wanted to develop, but we don't have time.
The limits of TV. Binky Chadha at Deutsche Bank. Binky, it's good to see you. Thank you, sir.
Thanks for having me.
Equity futures just rolling over. We're negative by 0.1%, a little more. We're down by close to 2 now. Let's get you an update on stories elsewhere with your Bloomberg brief. Here is Danny Berger. Hey, Danny.
Hey, John. The U.S. Navy has been instructed not to use AI from DeepSeek, according to CNBC. The Navy said DeepSeek's AI is not to be used due to potential security and ethical concerns associated with the model's origin and usage. The announcement follows the release of DeepSeek's R1 model that shot to the top of Apple's App Store after the company announced its tech rivals that of OpenAI and Meta. President Donald Trump and Elon Musk announced last night that SpaceX will retrieve true astronauts from the International Space Station, quote, as soon as possible. It's assumed that they're talking about Suni Williams and Butch Wilmore, who have been living on the space station since early June. The astronauts are already scheduled to return on a SpaceX capsule in March as part of a NASA mission. The capsule for the return journey is already docked at the ISS, and NASA has not commented on any changes to the mission. You can now use the official Trump meme coin to purchase watches and sneakers. Several websites selling Trump-branded products have started to accept the coin as payment. The meme coin's total market cap reportedly exceeds $5 billion and is now being accepted by other businesses like the travel site Travala.com. And that's your brief. John.
Check it out. Danny, thank you. Thank you very much. Up next on the programme, the Morning Calls Plus. Pierre Ferragu of New Street Research previewing numbers from Tesla. That conversation next. This is Bloomberg.
I'm Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
You were made to chase your passions. We were made to put them in a package.
Poor baby. Got a cough and runny nose. Any ideas? Stop guessing. Just go. Walk into a nearby Novant Health Go Health Urgent Care today.
From tried and true to try something new. So many ways to save. Life ready, wallet happy. That's 365 by Whole Foods Market.
This is Morgan. They never really thought about their credit scores until they had 8 roommates. Whew, that's crowded. So Morgan used Credit Karma to help them improve their scores and started saving for a down payment. Then they moved back in with their original roommates until they could afford their own place. Thanks, Mom. That's how Morgan finally found the perfect home with the perfect little roommate to match. Intuit Credit Karma. Download the Money app where your hard work pays off.
Are you looking for vacations?
I'm just exploring Travala to understand exactly the cryptocurrency. Well, you can do cryptocurrency, but it looks like the prices are somewhat higher and it's very slow. But I just had never heard of Travala before.
Okay, and is it like Expedia?
Well, yeah, it's sort of, but it's a lot slower and it has cryptocurrency accepted in every...
What about the range of hotels? And
I can't do that much research. I'm trying.
All right.
Actually, no, it wasn't more expensive. This is how much the costs are. Geez.
More expensive?
Than I thought it was going to be. No, it's not. It's just in general. Things are expensive.
Okay. Welcome. Equities look like this. I was going to say it's Biden's America, but of course it's not anymore. Equity futures down by 0.1%. Do you remember that? They'd put those stickers by the gas pumps and said Biden did this.
Yeah. Well, gas is actually really cheap now, but hotel rooms, forget it.
Not so much. Crude's lower by 0.2%. The 10-year just about unchanged. Yields down a basis point, 4.52. Let's get some morning calls. First up, KeyBank raising its price target on Meta to $7.50, saying open source technology will drive cost savings. Your second call from Oppenheimer, downgrading Apple to perform, citing reduced iPhone sales and competition in China. That name is down by 1.2%. Earnings from them tomorrow. Big story. And finally, Wells Fargo hiking its price target on GM to 37, citing potential tariff impacts on its bottom line. Sticking with the automakers, investors bracing for Tesla earnings after the closing bell. Joining us now to discuss, Pierre Ferragu of New Street Research, who recently upgraded Tesla to a buy and raised its price target to $460 from $240. Pierre, welcome to the program, sir. Let's start with the upgrade. Why the upgrade and why Monday?
Yeah, so we did upgrade the stock a few weeks back, and really our view was looking at 2025 on the auto business, you know, what's all the news flow that gets delivered quarter after quarter on the volumes and gross margin. We don't see yet, you know, green shots. We don't see like a recovery in demand, but we see like a situation where we are very close to the bottom. So from here, very limited downside risk. And at some point, we'll get new models. There is a new Model Y coming through right now. There will be new, like lower price point models that are going to help volumes. And at some point, pricing will ease, like the pressure that Tesla is under, like the rest of the auto industry at the moment, is going to ease. So things look relatively nice on that one. And then there is FSD 13. FSD 13 is really like a turning point in terms of self-driving capabilities. And even if we still see like many, many years before you see a very large number of robotaxis from Tesla on the road, we think this year the news flow and evolution is going to be very, very positive and is going to support the sentiment on the name. So what we're going to see this year is probably the release of a first like unsupervised version of FSD, like this idea that you can have your car driving you around and you don't need to keep an eye constantly on the road. And then the technology is probably right now to see like test fleets being deployed, and the company mentioned it in recent months, and we expect that to happen in Texas. So like this vision where Tesla becomes a company that can produce millions of robotaxi every year and redeploy them across the country and across the globe. It's still like a multi-year vision, but it's going to get more and more tangible this year. And so like the stock now is trading like maybe on 100 times earnings, which is where it has been trading when the market started really focusing on the long-term vision and saw the long-term vision becoming more and more tangible. That's really what we expect for the stock this year.
As you say, Pierre, this is the big long-term story. If we can get super near-term and just think about the last quarter and the next quarter, if I can just sit on that just for a moment, what did we learn yesterday from the likes of General Motors? What did we learn from them about how sales are developing and whether pricing power is sticking?
Yeah. So what we've heard is like the same story we've heard in the last 15 months, which is that auto demand is not recovering yet. It's still like at a very low point. And so I wouldn't be too, you know, demanding on what to expect tonight in terms of numbers. So we know already like deliveries, they're slightly down year on year, recovering sequentially. They are like 30%, 30% above the run rate of the beginning of the year. So Tesla continues to be able, you know, to expand even in this very difficult market condition. But that we know that there won't be any surprise. We already know the delivery numbers. What's going to be interesting, of course, is the gross margin. We do expect pressure on gross margin. It was particularly high in Q3, like benefited from a lot of tailwinds. And what we've seen in Q4 is that Tesla has still been very aggressive, very active on discounting, on promotions and things like that. And of course, this means the pressure on gross margin is still around. It's well into expectation. The key question is, can Tesla deliver 20 to 30% growth, as Elon indicated for 2025? And on that one, I would say, if we close 2024 on a run rate that is like 30% above, 20 to 30% above where it was at the beginning of the year, we're in a good position to do that. And what we need to hear on the call to gain confidence about 2025 being a good growth year for Tesla is actually some more insights on how the new Model Y is doing and what comes next this year in terms of new models. Because remember, in auto, we are facing an extremely elastic market. If you can get into the market with lower price points, you massively, instantly expand your addressable market. And that's really what Tesla needs to deliver this year to deliver like a very strong quarter after quarter, like sequential trajectory.
So right now, Pierre, the actual numbers in terms of deliveries and sales might not matter as much as some of the longer-term story that you're talking about. Margins do matter. We are going to also be hearing from Apple and Microsoft, both of which you cover. Do you think that their earnings are going to be actually more important than even Tesla's in giving a sense of direction for the stock, but also for how they are going to invest?
Yes, I think you will have way more attention on Microsoft and Apple tonight than on Tesla for the reasons you just mentioned. You know, the market for now is wondering who's going to invest in the AI infrastructure going forward, and is like the AI infrastructure deployment still as vivid as we expect? And yes, that's going to be most of the focus of the market tonight. And of course, Tesla is deploying a lot of AI infrastructure, but it's going to be very secondary on the earnings call tonight.
Pierre, you have a neutral on Apple. You've had a neutral on Apple, a neutral rating on Apple for quite a while. What would you have to hear this afternoon to make you more bullish at a time where some people are saying that Apple actually looks like they were wise to not throw as much money into AI development at the earlier stages of adoption?
Yes, it's a good question. Yeah, it's actually very difficult to be bullish on Apple at this level of valuation, simply because the laws of large number applies to the company. It's there isn't a bull case, you know, reaccelerating earnings growth for Apple. So it's a very high quality company, a very high quality name, and it's reflected in the stock price. And so when you have like a maxed out multiple and very limited earnings growth potential, like single digit, maybe low double digits earnings growth potential, it's difficult to get excited about the stock. So I think my neutral rating that now is like several years, has been in place for several years, is really a rating that is waiting for like a better opportunity to get into the stock. And unfortunately, today, Apple is facing actually a bleak outlook. You see more and more downgrades from my peers, because yes, that's something we've been calling since the summer, which is that the outlook for the iPhone is not good. You know, like this AI evolution is actually going to be a multi-year evolution for Apple. It's not going to have like a positive impact on the momentum of the business in the near term. And so this year should be relatively weak for the iPhone, because people will wait for the next iPhones, and people like the replacement activity has been quite strong in the last couple of years. So I would expect like, you know, a bleak outlook, and maybe the stock reacts negatively to that and creates an opportunity actually to buy a very high quality like staple name. But that's really valuation that is an issue for me here.
Not trading with the valuation that you like. Pierre, thank you, sir. Pierre Ferragu there of New Street Research on Apple. Apple and Tesla similar in one way. The core business is not seeing any growth. The difference is that Tesla has got this grand vision of the future that Apple right now doesn't have.
Although some people are saying that they benefited from not investing as much in some of the chips in the data centers, if what we saw is true.
Up next on the program, a sprinkle of economic data from New York. This is Bloomberg.
Poor baby. Got a cough and runny nose. Any ideas? Stop guessing. Just go. Walk into a nearby Novant Health Go Health Urgent Care today.
Some days your health journey just can't with the kale. No worries. It's about progress, not perfection. Slice today, salad tomorrow. MyFitnessPal. Download now. Some days your health journey calls a timeout. All good. It's about progress, not perfection.
Nachos.
Nacho cheese today, not nacho cheese tomorrow. MyFitnessPal. Nutrition tracking for real life.
Whether you're looking to start the year in a new Subaru or Subaru certified pre-owned, Fred Anderson's Prestige Subaru has the Subaru for you for only $299 a month. $299 a month, all backed with lifetime oil changes.
It's a Subi thing.
This is Carl. He never really thought much of his credit scores. Well, until he got Credit Karma and used his scores to move on up. By putting in the work to improve his scores, he got access to a better credit card. And that sofa she liked. Ooh, is that Saffron Sunrise? And when it came time to buy a home of his own, Credit Karma helped him take things to the next level. Just in time. Intuit Credit Karma. Download the Money app where your hard work pays off.
Want the fastest working GLP-1?
For half the price, Ro now offers FDA-approved weight loss injections cheaper, with results you can see faster. Lose 15% of your weight with the formula from Eli Lilly that hits not one, but 2 hormones to curb hunger and nausea. Weight loss faster, confidence higher, price cheaper. See if you qualify at ro.co/TV.
Fun place, isn't it, Mama?
So dumb. I'm doing your washing and your laundry and your cooking for you. What on earth is that wife of yours doing for you? Well, good Lord, there goes my appetite. Just spit it out.
Is everybody happy? When's the last time you saw a family smarter than this one?
Last time I watched the Flintstones.
Watch Love and Hip Hop for free on Pluto TV.
It might lighten the mood.
I'm gonna do whatever I gotta do.
Is this exciting for me?
You need to check your.
Look at you loving me. I see it.
Taking over the world, baby. Let's go.
I love that. I ain't got 100 million. I can't chill yet.
Well, I'm definitely in love, but if they don't get this together, I'm done.
Watch Love and Hip Hop for free on Pluto TV. Stream now. Pay never.
We've got really great news.
Y'all gonna trip out when y'all hear this.
The sitcoms you love are always streaming on Pluto TV's Black Classics channel.
Perfect.
With back-to-back episodes of Sister Sister.
That's us. Isn't this wonderful?
And Moesha.
You were supposed to wear your suit. Look like a gangster Urkel.
Weekdays starting at 10:30 a.m. Eastern on the Black Classics channel.
Now that's a good schedule.
On Pluto TV.
60 minutes away from the opening bow with equity futures on the S&P down by 0.25%, just a little bit softer. In the bond market, 2-year, 10-year, 30-year shaping up as follows. Going into some economic data in just a moment, and of course the Federal Reserve decision later on this afternoon. The 10-year at 451.83, very close to where it was at the close the last time the Fed met on December 18th. The 2-year opened up that day at 424. The 2-year right now 418.87. With that data and looking ahead to that Federal Reserve decision, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we're calling this one number to rule them all. We haven't talked much about trade in recent years, but since it's the way Donald Trump keeps score, let's take a look at the advanced goods trade balance that just came out, negative $122 billion. That is far, far higher than the previous $102 billion, and certainly way above the 105 that was forecast. Now, this does not include services. We'll get the total trade balance next Wednesday, but we are starting off on a bad foot here. These are December numbers that comes into the Trump administration with the trade deficit widening, and he's definitely not going to like that, and that will probably feed into whatever happens this weekend.
Mike, how much of that is just front-loading orders ahead of potential tariffs?
That is a very good point. A lot of people have suggested that perhaps that's what companies were doing, trying to stock up. And there are folks, Joanne Shu at the University of Michigan says when they have called people for their survey, Americans have said they've wanted to buy things like cars and refrigerators ahead of time because they're afraid prices are going to go up. So we're going to have to watch that as a possibility and see if once we get to the January numbers, that comes back a little bit.
Mike, thank you, sir. Stay close. Mike McKee, of course, down in Washington today because Mike McKee will be in that news conference for the Federal Reserve a little bit later on this afternoon. We expected some front-loading, didn't we? Seems like we're getting a bit of it.
What's interesting to me, and I don't know much sort of insight into exactly why, but I'd love Mike's thoughts later on about the wholesale inventories actually fell and they were expected to rise. So if they're stockpiling, it's not showing up in inventories, which is interesting to me. How much are we actually seeing stockpiling versus how much are people buying ahead of any potential tariffs, given that it is sort of filtering into the zeitgeist?
I think Mike's still there. Do you want to ask him?
Yeah, I do. Mike, what do you make of that? If you could tell us about the idea of wholesale inventories declining by 0.5%, even though they were expected to increase. If we actually saw stockpiling, wouldn't we expect that to go up?
Well, we would, and that's an interesting question. It's a little hard to pull out wholesale inventories, and retail inventories also out this morning showing a decline because of the holiday season. It is possible stuff came in and went back, right out the door, and we don't know exactly the composition of that yet. But I'll look into it and see if we get enough of a breakdown to be able to tell.
Mike McKee, thank you, sir. We'll throw these questions at someone else and see if we can get an answer. Blorino Urucci of T. Rowe Price. Economists are all the same, aren't they? On one hand this, on the hand that. Blorino, we want answers. How do you explain the data from a few minutes ago?
I would go back to the U.S. consumer because we're not seeing any evidence in the Q4 GDP tracking data that we have an inventory buildup. When you look at the contributions there, inventories are actually the only component that is a drag to growth in the fourth quarter. So I think the trade data are basically telling you strong consumer spending in goods, and we do indeed import most of that. So I haven't seen evidence in the data yet of stockpiling. That doesn't mean that there's not going to be some bringing forward of spending by companies there, but it's not in the Q4 data.
Well, Blorino, just to sort of broaden
that out. We go back to the consumer and the labor market that is supporting that spending.
Blorino, just to sort of broaden that out, there has been this sort of push-pull about whether we're reaccelerating or we're actually seeing some sort of weakening in the overall economy that will lead the Fed to keep cutting through the remainder of the year. Yesterday, we saw consumer confidence take a hit. It came in much lower than expected. There has been this increase in expectations of job insecurity. Blorino, do you reject that? Do you sort of focus on the consumer and consumer spending as being the more dominant tell of the strength of the U.S. economy?
U.S. economy. We are seeing some signs of loosening in the labor market and deceleration in growth. I think growth in 25 is going to be slower than last year, but it's not going to be weak. Employment growth is solid. There is job security. No signs of mass layoffs there that would make workers worry about the outlook of employment. Of course, we're hearing now about federal government employment, but the majority of employment in the economy is provided by the private sector. So I think we still have a strong economy. And I don't see, even though there may be some wobbles in terms of consumer confidence, I don't see consumers really holding back so far.
Blorino, how much, when we talk about the pause or the skip, which is going to be the exciting moment of the news conference later today with the Federal Reserve, will they indicate this is just a break in a downward path of rates, or potentially this is it? What are you looking for in terms of where the emphasis is, and where would you land in terms of that debate?
So I expect to learn nothing from this press conference. And I think that would be a measure of success for Powell, that he doesn't give anything away. And so what that does is to leave us watching the data. So when the Fed started cutting interest rates back in September 2024, they were really worried about the labor market cooling rapidly, the unemployment rate increasing. What we've seen since then is a pickup in employment growth and a decline in the unemployment rate. So that reason that pushed them to cut by 50 basis points in September last year seems to have moved in the opposite direction. Now, maybe they want to take credit that they helped stabilize the labor market by easing policy and financial conditions, or maybe there is underlying strength here and the data over the summer was just a bit noisy. We'll see. But I think essentially now the only reason that the Fed might have for cutting interest rates is this idea that where we are right now, monetary policy is restrictive, and we want to gradually move towards being neutral, because you don't want to stay restrictive for too long, especially with inflation coming down quite significantly from the 2022 levels. Now, the problem here is if the economy is not weakening and progress on inflation is relatively slow, what's the rush? So I think that leaves me with the Fed is wanting to cut interest rates. It has a dovish bias, but the economic developments don't support it to cut interest rates in the near term. And then we have all the policy uncertainty coming from the new administration. So I have to keep an easing bias in my rate forecast, but I'm thinking at the earliest interest rate cuts will come in the second half of this year.
Manchester City versus Club Brugge at 3 p.m. Eastern Time, if you're interested. Okay?
Yeah, you know,
watch the build-up to the game
I love
as well.
it. Okay,
News
can I
conference
just
starts.
say, you start the show, we're so excited. It's going to be an incredibly important Fed decision. Just wait. And we have gotten so beaten down in 37 minutes.
Hold on a minute. I don't think I ever said that.
You did. You sounded
if I
excited.
Said that was
Pure
very
sarcasm.
disingenuous.
Oh, I know, but you did.
I'm sure
but
everyone could feel the sarcasm.
4 minutes we spent talking about it.
Yeah, 4 minutes too many. Blurina, thank you. Blurina Urucci there of T. Rowe Price.
Thank you for having me.
No one thought I was being serious.
I did.
You thought I was being serious?
I took you so seriously.
You thought I think this is a big Federal Reserve decision.
I think you're really excited for it.
Look, I think with Chairman Powell, he's capable of anything, and he could flub this one too.
Well, that would sort of be his to flub, because as everyone's been saying, it's expected to be incredibly boring, and that would be the successful way for this news office.
We can set up a screen over here. I can log into my Paramount account, and we'll make it happen.
You're going to be watching.
Yes.
You're going to be watching football.
2 screens.
2 screens.
Chairman Powell, bit of football at the same time.
This is quite the promo.
Mike McKee can't do that. He'll be in the room. Mike McKee, for Chairman Powell today, it feels like a non-decision, no decision to make. They're not going to cut interest rates. They're certainly not going to hike. What do you expect them to do?
What time does the football game start, John?
3 p.m. Eastern Time.
we might watch it in the briefing room. I don't expect him to do much of anything. I think everybody's been telling you that today, that the Fed wants to get in and out of this without making any news. There's enough going on. The Fed has enough headaches without provoking the president even more. You know Jay Powell's going to be asked about it, but he'll probably dodge that question. The only thing that markets might get out of this, or that they're really looking for, is any kind of hint about what might happen in March, and I suspect we'll miss that too. There is one area in which they could make news, and that's the Fed balance sheet. They're expected to stop QT sometime this year, and they haven't given any clues to anybody about how and when. So with nothing else on the agenda, they might be able to put something out on that today. We'll take a look for that, and that might be the best that you get, unless the football game's exciting.
It will be. Mike McKee, thank you. If they lose, if they don't win, you know, they go out of the Champions League. This is a big deal. Manchester City.
I'm going to be looking at the balance sheet.
And not Manchester City and the future of Pep Guardiola.
Yeah,
okay.
Well.
Krishna Ramani follows the Fed very closely. Joins us now from Lafayette College. Krishna, it's good to see you.
Good to see you as well.
Can you make this afternoon interesting?
Well, no, I mean, if you think about it from the Fed's perspective, everything is kind of working out according to plan, the way they laid out the plan in the last meeting. And nothing has really changed, which is growth is really good. And the inflation is coming down, but at a very slow or much slower pace than they would probably like. But they are worried about the labor market and don't want to cancel that optionality. What they're not worried about is significant pickup in inflation and therefore the need to tighten. I think that is really the one point. If I can see anything come out, that probably would be one point.
So skip or prolonged pause sounds like skip for you.
Absolutely, skip is the right way to think about it, because you know, anecdotally you can come up with a lot of talk about labor market softening. But it really, at the aggregate level, it really isn't. So they want to cut, but they don't have the opportunity to cut, and that's where we are.
So you expect them, and Krishna, this would actually be real news, you expect them to completely remove the possibility of an additional rate hike from the table at a time where some people are saying that could potentially be the big issue later this year.
So what I would say is that they would never kind of take it out altogether. But I think if there is some tamping down to be done, it probably is on that front, so that people don't expect that they are on a pause for a very, very long period of time with the possibility of rates going up. That doesn't really serve their purpose, because they are focused on the labor market. They're not seeing the weakening, but they're worried about that weakening.
So it seems like we can't really get forward guidance at a time where the Fed is not in the pole position when it comes to understanding the trajectory of inflation or when it comes to policy. So how potentially disruptive could they be if they take a decision that is counter to what the markets basically are implying?
Well, so I don't think they can be very disruptive. The markets today are being driven by other things other than the Fed. Fed is, of course, the larger context in the market, but I think what you're dealing with right now is what happens in the equity market with AI and other stuff. And that thinking is dominating everything, and that is probably going to be with us for a while. So, if you think about it from a market convexity standpoint, the convexity profile is highly negative. That is, the upside is broken because of the break in the narrative, and the downside is quite significant. So if bonds move a lot, it wouldn't be because of fundamental data, it'll be because equity markets have corrected a lot, or the Fed said something. Or it wouldn't be because of the Fed said something. It's going to be driven by what happens in equities, the way it happened on earlier this week. I think that is going to be the driver rather than the Fed or even earnings for that matter.
I've known you a long time, and over the last decade since I've been in this country, when we have these turning points in markets, I've sat down for lunch with you and you've gone through what's about to happen. I have to say, your track record, in my experience, has been absolutely phenomenal on that front. Do you believe that was a big turning point for equities on Monday?
Oh, absolutely. Absolutely. Why? So, again, people make it out of, well, AI is still going to progress and the cost has come down. It's none of that. I mean, all of that is still very much in place. The fact that DeepSeek can come up with a lower cost model doesn't change the overall fundamentals. What it changes is your valuation thinking. That is the super premium that you were willing to pay because you thought that it could run even more. That is what you're questioning. And therefore, I think it's not because any technological development. It's really more about market sentiment and how they feel about paying 100 times or whatever on various stocks that they are willing to pay based on a certain narrative.
You say various stocks. Do you mean the whole universe of equities, or do you mean certain pieces of the AI story? Is it the energy piece of the story? What is it?
I think there's a lot of stuff that went up on the back of AI. Energy, quantum computing, cash flow producing entities, the downside on them is much less. On the other hand, anything that was based on capital spending on the back of the AI wave, I think you have to question that. It's not that Meta is going to become less profitable. They are hugely profitable and they can generate good earnings, but kind of speccing on quantum computing, expecting or data centers and the demand for electricity and nuclear producers and things like that, those are the sort of things that we have to question.
How much did you shift some of the allocations that you have as a result of that potential tipping point, that nuance in the AI adoption cycle?
Well, so, we didn't shift much because we never loaded it earlier. So, it was, what we did was not rebalance the portfolio and let the equity market run. What we are thinking about now is to rebalance the portfolio on a consistent basis, far more than what we would have thought earlier, because now it is about risk management. It's about protecting your downside because, as I said, the convexity profile is very negative at the moment.
You said something else that I thought was instructive, that the bond market's going to move more responding to earnings than it will to the Fed. What do you think could happen, and what's your interpretation of the fact that bond yields went down on Monday? Is it the idea that potentially broader adoption of AI would be disinflationary? Is it just a risk-off trade that bonds now have the same relationship as they used to have pre-pandemic?
Well, so I don't want to kind of oversell that particular idea. I think the fact that bonds only went down 10 points when NVIDIA lost $500 billion sort of gives you an idea as to the magnitude of that particular. I mean, bonds have headwinds too. It's not that they're free. When you have 3% growth rate, expecting 10-year to get to 3.5%, I think it becomes very, 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 very challenging. But the point, however, that I would like to make is, if one, don't have a view. That is really not helping you at the moment. And second, if you have a view on the downside on bonds rather than upside on equities. That's how I would kind of characterize it.
So take a view right now. Do you remember Bloomberg real yield? Rapid fire at the end. 450 right now on 10s. What do we hit first, 4 or 5?
Oh, 4 rather than 5.
4 rather than 5?
Yeah.
Krishna, appreciate it. It's good to see you. Thank you. It's a lot locked into that answer about where you think this market's going, right?
I love it. You really you miss it. We should do rapid fire.
But honestly, it's too much, Brahma.
Yeah, but I know, I hear you, but you could have said 4.4 or 4.75.
No,
that would have been
stretch out.
I know you want to make it that much bigger, but
sure.
We were talking.
All right. Okay. Can we move on? We good? It's good to see you, mate. As always, thank you. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that Microsoft and OpenAI are investigating whether Chinese AI startup DeepSeek obtained unauthorized data output from OpenAI technology. Sources say that Microsoft had observed individuals that they think might be linked to DeepSeek taking a large amount of data using the OpenAI API. Earlier, the White House AI chief, David Sachs, told Fox News that there was evidence DeepSeek had leaned on the output of OpenAI's models to help develop its own tech. Bloomberg has also learned that Apple has been secretly working with SpaceX and T-Mobile to add support for the Starlink network in its latest iPhone software. In an under-the-radar move, the smartphone's latest software update released this week now supports the technology. The initial version of Starlink is exclusively for texting, but SpaceX and T-Mobile had previously said that they and voice calls in the future. Novo Nordisk's popular weight loss drug, Ozempic, has been approved by the FDA to treat chronic kidney disease in patients with type 2 diabetes. Studies have shown that Ozempic can reduce the risk of death in patients with kidney disease caused by diabetes. Novo Nordisk shares, for their part, are getting a slight boost, 0.7% in the Denmark trade. And that's your brief. John.
Hey, Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the trading day. We'll catch up with Manus Cranny, get you some movers, and then we'll head down to Washington, D.C. to catch up with Anne-Marie on the Federal Reserve, because the politics of this could be more interesting than the decision itself. That conversation up next.
I'm Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
At Health Equity, our mission is to save and improve lives by empowering healthcare consumers. We work with employers to help their people understand their benefits, and we help them accumulate money tax-free into a health savings account. Wells Fargo has been a fantastic partner because they understand the market. That's really been the jet fuel of our business. We are supporting the HOPE Act, a bipartisan bill in Congress so more families have access to a health savings account. An ounce of prevention is worth a pound of cure.